Since the crises, settlement banks' central reserves have shot up dramatically. When bank customers transfer funds from their account to another person's account, a process called intraday clearing occurs. The amount of central reserve currency Bank A has at the Bank of England is reduced by the corresponding amount that Bank B receives. This is the importance of central reserve currency to banks. Before the credit crisis, if a bank was short of central reserves at the Bank of England to meet its obligations, then the bank would have to loan reserves from other banks with interest.
If you sell something on eBay, you know that that deal's not complete until you get some money put into your account. You know, most people actually want to see the money in their account before they're happy to close on a deal. Now the banks are pretty much the same, but they want to see the money in their account at the Bank of England before they consider a deal complete. So for example, if you're buying a house from somebody who banks with a different bank, then what'll happen after you spend £250,000 on a house is you'll tell your bank to transfer some money to the house seller's bank. And what the bank will do is actually instruct the Bank of England to move 250,000 from their account at the Bank of England to the bank of the house seller. And that money will actually move across between the accounts at the Bank of England. When that money is moved across, then the banks will consider that that payment has been made, it's been settled. They don't really deal in the kind of money that we have in our accounts. They deal in this special money that can only be used at the central bank.
There are millions of people across the country, all transferring money to each other using only a few major banks. These banks can keep a tally on their computer systems, and usually many of the movements cancel each other out at the end of the day. The 5 major banks, RBS, Lloyds, HSBC, Barclays and Santander, hold over 85% of all deposits. As there are a limited number of banks in the system, the central reserve money can only be moved around them in a closed loop.
The money is just circulating through the system over and over again. And if you think about it, a £1 coin could be used to make £1 billion of payments if it was circulated 1 billion times. And that's effectively the system that you have now, is you have a small pool of real money that's just going round and round the system, and it's being used to make a huge quantity of payments on our behalf. Just before the crisis, there was only £20 billion in the accounts at the central bank.
September 2007, thousands of Northern Rock customers queue up to withdraw their cash. The company had been forced to seek emergency funding. It's the first run on a British bank in 140 years.
If they don't have enough of this central bank money, then effectively they can't make payments. And if that happens, then pretty quickly the entire system seizes up. So the Bank of England has the responsibility of making sure there's enough of this money in the system.
The requirements for banks to hold a specific amount of reserves has changed many times since 1947. At that time, banks needed to hold a minimum ratio of 32% of reserves, cash, or treasury bonds to deposits. In 2006, the corridor system was introduced, in which banks could set their own reserve targets each month. The rules changed again in March 2009, when the Bank of England introduced quantitative easing. Quantitative easing, in effect, gives settlement banks the central reserve currency for free. The central reserve currency is what is referred to as the real money in the fractional reserve model. But the fact is, banks can have as much of this as they want. and central reserve currency itself is a form of fiat money, which is backed by nothing. As a consequence, there is no longer a meaningful fractional reserve.
If you look over the history, the last 150 years or so, you start off with the development of a gold standard that really comes to the fore in the 1880s, 1890s, where essentially countries peg themselves to a particular defined value of gold, and then they have an agreement to fix that value, to hold that value, and to trade gold amongst themselves to make sure the balances are all there, and also to try and restrict or expand or contract activity in their own economies to make sure that the balance, that particular fixed price is maintained. That disintegrates after the First World War. I mean, this is where the whole thing breaks apart. Very major dislocation in the international monetary system at that point, not really resolved until you get Bretton Woods agreements at the end of the Second World War, in which everything is pegged to the dollar and the dollar is pegged to the gold. So you're kind of one remove from gold backing, or saying that there is a definite, sort of solid commodity money behind the paper money and the credit money that we're all using over here. You're kind of one remove from it.
After Hiroshima, Tokyo wondered when the next atom bomb would fall. They did not wonder long.
In 1944, at Bretton Woods, the US and the UK began to negotiate how to govern the world economy, the world monetary system, and came up with the World Bank and the IMF and a series of other institutions designed to manage the global currency. And there was still a gold standard, but this gold standard was going to be tied to the dollar. All of the world's gold had moved from London to Fort Knox, and all of the world's currencies were tied to the dollar. This system was designed to manage the sorts of imbalances, to avoid credit crunches, or for countries, the credit crunches are known as balance of trades deficits, i.e. when they can't pay their bills and their currency collapses. The currencies were managed, and the system was stable, as long as the Americans played the role of oversight. Now, who knows the great story about how that all came to an end? So the quantity of money that was needed to pay for the Vietnam War, that's exactly what I was trying to get at. Oil shocks was another one. That meant that the Americans were no longer respecting their role or playing their role governing the monetary system. They were inflating the value of their own currency, but ostensibly it was meant to be tied to gold and to every other currency. So what did the French do? The French were a little bit worried that President Nixon wasn't entirely honest. And they were worried that precisely what we described, that Nixon was printing money when he shouldn't have been, was going on. And they were worried there wasn't enough gold to honor the exchange rate of the French franc. So they sent a gunboat to New York Harbor to ever so politely ask for our gold back, please. Did they get their gold back? Go on, guess. They didn't. And the Bretton Woods system came to an end. And this is the point in which we enter the modern era of the financial system.
Historically, money creation was pegged to a commodity, often gold, but today it is pegged to nothing.
Which means there is nothing backing our money. This piece of paper is just a piece of paper. Where does this leave us? If money is based on nothing, why do we think it has any value? Sorry? Because we can still go and exchange it. What? Well, somebody else was going to shout. Great little Latin fact, the word for credit comes from belief. Correct.
Since the collapse of the dollar gold standard in 1971 and the deregulation of the financial system, money creation has grown exponentially.
The World Economic Forum meeting in Davos at the present time have called on a need for the credit within the economy, the global economy, to be expanded by $100 trillion, 100 trillion US dollars. A trillion is 12 noughts, so 100 trillion, if you want to imagine, is a 1 followed by 14 noughts.
They believe this credit expansion will create a boom, because there is now more money in the economy with which to make investments.
It's fascinating the emergence of digital currencies, how it's transformed everything really, because it just completely unleashed private banks to dominate and create the money system that works for them and works for the people who run private banks.
If we want a growing economy, under the current setup, we have to have growing debt. You can't, this is something that very, very few people really understand, especially not the politicians who are managing the economy, which is a scary thought.
As the money supply grows, more money is available, which can be invested in productive avenues. However, it can also be used to gamble and drive up asset prices. Inflation is a rise in the general level of prices of goods and services in an economy over a period of time. When the general price level rises, each unit of currency buys fewer goods and services. As the money supply grows and there is more currency available, more money is available for investment, which can lead to growth. But more money is also available for purchases of goods and speculation, which leads to inflation.
Essentially, inflation is what happens when too much money is chasing too few goods and services. So there's too much money for the actual output of the economy.
However, in practice, inflation is much more skewed and complicated. Measuring inflation is not a science, and the way it is recorded poses a dilemma. The Consumer Price Index, or CPI, is measured from a sample of goods and services. Each category of goods and services is given a weighing data, which determines the overall impact of the price data for a specific category. However, this measure is deemed to provide a consistently low figure for inflation. Interestingly, house prices, mortgage repayments, and council tax are excluded. Yet apps and dating agency fees are included. The Retail Price Index, or RPI Inflation Index, is another way of measuring inflation and scores consistently higher values than the Consumer Price Index. Recently, many pension schemes have adjusted their annual payout increases from RPI to CPI. This is another cost-saving measure which will leave pensioners worse off in future. The CPI index of inflation is not geared towards providing an accurate picture of inflation and the deterioration in the purchasing power of money.
In the 7 years between 2000 and 2007, the money supply doubled, and the banks, the central bank, the Bank of England in this time, was under the impression that they had it under control because they were saying, prices aren't going up that much. Of course, they were only looking at prices in your local corner shop. They weren't looking at the price of housing, and housing is, the biggest expenditure that most people will make.
Increasing house prices, it may make you feel like you're becoming wealthier, but as your wealth increases, the effect is that your children's wealth is actually decreasing. So in fact, there's no net gain in wealth because your children are going to have to pay even more when they want to buy a house. So in effect, there's no